Hey, this is Sean here with WickQuidity. Just wanted to start this video saying that this is the first episode or first lesson in a several lesson series I will be doing on supply and demand. And I'm going to simultaneously try to start a series on liquidity. And I'll probably kind of bounce back and forth as we get just deep enough into each subject to relate one to the other, and then hopefully circle back at the very end and give a complete system on how to trade. That's several videos down the road, probably several weeks down the road at best. So, here we are on the charts. If you're looking at this chart here, this is TradingView. Um, this is the pound dollar future. Uh, I don't typically trade this, but I wanted to have something that I wanted to pull up a chart that I knew I had no familiarity with so that we could walk through this thing kind of live, or as live as we can. And maybe I'll do some market replay stuff at some point in time here. I don't know if that's where we'll go on this video just yet. So I know you guys see this thing at the bottom here. This is not an indicator. This is just, I typically trade with three charts open, three time frames open. So when I loaded the pound on, it loads to all three. So I just scroll that down and get it out the way. All right. So let's talk about supply and demand. What is supply and demand? What is liquidity? Those are two very important things that we all need to understand. And that's whether you end up trading my system or not. Understanding what supply and demand is, where it is in the market. Even if you trade a completely different system, it can help you refine your entries. It could help you make better targets when you start combining supply and demand and liquidity theories. So, quite simply, supply and demand is just the area on the chart where price moved out of aggressively. I know you guys have heard this on 1,000 YouTube videos already, but me and you as retail traders don't move the market. We are either liquidity for moves or we're riding a move that the larger banks and institutions have made. There's really no in between. We're either their liquidity or we're riding on their coattails. So supply and demand areas are kind of the footprints that these larger institutions and banks leave behind when they've placed their orders. And one important concept to understand is price does not move because you place a buy order, or even the banks. Price does not move because somebody placed a sell order. Price moves because there is no opposing orders. And that's an important concept to understand. I don't hear anybody really talking about that. So in theory, if I place an order and I place the order for the British pound and I want to buy the pound at $1, and I hit the button. Starts at $1, but there's no sell orders available at $1. It'll go to 101, then it'll go to 102, and that candle's going to constantly move until somebody on the other end hits the sell button and sells me the British pound. Price does not move because you hit the buy button. Price moves because there was no opposing order for the buy. Please understand that. That's why you hear a lot about fair value gaps and things. That's why fair value gaps and those large candles are called imbalances. When price is balanced, meaning there's a pretty relative equal number of buy and sells, you end up in consolidation or in small ranges. But when there's a lack of the opposing orders, you now have a run. A lot of times large candles, whether bullish, bearish, whatever. So you need to understand that. Okay, that is something I don't think I've heard anybody detail on YouTube. And I feel like I've watched probably more YouTube than anybody here listening. I've got thousands of hours going down rabbit holes, especially before I became profitable, trying to learn every little nook and cranny of the market that I could. And I don't think anybody's ever really explained that to me very well. So I hope you take that nugget and we'll apply it on the charts. Okay? So I'm going to put my cursor here on this left-hand chart, which is the 15-minute. And you know what? Maybe we'll just start like this. So the areas we're going to talk about, I'm not saying we should trade these as they sit. I'm just trying to help you identify what a supply and demand area is. Okay? So, you see all these nice runs. You see this big bullish run here, this big bullish run here, good bullish run here. What happens to cause that is somebody put in orders in this area right here, right? Because this is the area where price was kind of moving down and then exploded up. Okay, so somebody put in a bunch of orders right here. Now these candles that show imbalance, these large bullish candles. Remember, what is imbalance? It is the lack of opposing orders. So what that tells us is whoever hit the buy button here, or whatever groups hit the buy button there, because it could be multiple banks, multiple institutions, put in so many orders that there was no longer sellers in the market, or no longer enough sellers in the market to fulfill their orders. All right, and they know this ahead of time. Okay, they understand this. So what they do is they stack their orders, and they do multiple orders. And so because they're getting filled, there are some sell orders in here, just not nearly enough to fulfill the amount of buys. Okay, so whoever bought this is really wanting their average price of being filled to be as close to this area as possible. Okay, so they bought. Finally, enough sellers stepped in to fill all of their buys, and price started to come back down. Now, I know this isn't a textbook example, but it comes right back into the zone and then rejects again. Okay? So, in this theory, what could have happened is this buyer got in their first set of orders, got up here, started seeing the sell orders fill. They understand that, or their buy orders fill. And then they could have closed their positions on the initial order. And it run back down. Back into their second positions that they had sitting down here to run up. That's a really simplistic explanation. If you look at supply and demand, anywhere there's a big move, a lot of times there is a secondary move that fills the orders and that reacts, if that makes any sense, to the zone. Here, nice push up, pull back, nice push up. Here's an example of one that at least no time in the near future does it ever come back to. Here's an example. Oh, sorry. Here's an example. Boom. Nice push up. Ran back down, reaction. Okay. It works in both directions. We just happen to be in more of an uptrend at this point on the chart. It's so simple. In theory. Run up. So you can actually highlight the bottom of the move or any basing. So the old school thought in supply and demand was they had rally base rally and drop base drop. those were kind of the bases, were the areas you were interested in. So here you have a drop, a base, and a rally. Here, from this perspective, you have a rally, a base, and a rally. So anywhere there's a pause in price prior to a big move, you can consider that a supply or demand zone. So in this area, we have the low here come up, consolidate, and explode with that large candle there. So either one of those could have been valid demand zones. Just so happens this is the one that reacted and ran up. So I'm going to zoom in a little bit more. All right, so as you guys have probably heard in other videos, because I'm sure this is not your first video on supply and demand. If it is, great. To qualify for supply, to actually be a demand zone, not only do you have to have a nice reaction on price, the price has to accomplish something. Price has to break structure of some sort, right? So here, so that move broke the high here. That came down. This move from this zone up. So now this is another valid supply and demand zone. And as you see, when we come over here, price reacts. Boom. You could call this area a supply or demand zone. Not my favorite, but you could call it, because it's the reaction. I mean, it's the base before the push up that clears this zone. You could call this, remember we said pauses in price action. You could call this, and depending on how you draw it, some people draw wick to wick, some people draw just the base or just the candle. You could have got a reaction there, or you could have just got blown through there. Okay, so it's a very simple concept. Find a place a price moved out of, preferably with fair value gap type candles, like this one right here. Boom, boom, boom. Preferably with a 2 or 3 to 1 move, meaning if this zone is 10 ticks, then you want the move to be at least 20 or 30 ticks. You want this move to be strong. And the reason for that is when we do our entries, we are trying to buy or sell. So in this case would be a sale back down toward these lows to maximize our risk reward. Now, I've said it before, I'm not a huge RR guy where I'm trying to swing for 10 RR and things of that nature. I'm more of a 1.5 to 2.5 pretty consistently. The data on my funded account right now says my average risk reward is 1.83. So 1.5 to 2.5 is kind of where I try to stay consistently. It's a good number if you like winning a lot of trades. Okay. Now, that doesn't mean you can't make money the other way. But as I've stated in one of my previous videos, that's what worked for my mental health in trading. The mental side of this, the psychology side of trading, is so underappreciated and undertaught because it's a very nuanced subject, and it's so hard for inexperienced traders to understand. And it's so hard for experienced traders to put into words in a way that makes sense for new traders. But trust me, you have to figure out how to keep your trading mental health good, in a good space, or this industry will eat you alive. It did me for years before I became profitable. All right, back to supply and demand. Sorry for the tangent. So here we have a run down. So you could call this supply. You could potentially call that supply. You could even potentially call that supply. Now, we'll talk about it later because you're going to look at this and you're going to say, well, price didn't really react here. Price didn't get a little reaction as it passed the zone back into it, but it didn't. That was more of a break and retest. Didn't really react there. And then it gets up here and it reacts. But over here on this other example we did, where was it? Right here. The middle zone reacted. The pause, the rally, base rally is where it reacted. But here on the drop, base drop, it didn't react to either of the bases. Why is that? If you want an honest answer, nobody knows. Right? Which is why when I trade, I go down to lower time frames and let price tell me that it's now going the way I need it to go. Some supply and demand people or mentors, traders on YouTube or gurus elsewhere will teach you to place pending orders at the zones, and they teach you how to qualify the zones to be the most accurate zones. And I'm not going to tell you that that's an invalid way to trade, because obviously people are making money doing it. It didn't work for me. What worked for me was identifying any zone that I thought was reasonably strong and waiting for the lower time frame to tell me, yep, this is valid. Okay? So we're going to keep going forward here, and we're getting toward only backed up a couple days. All right, so you could call this a supply and demand zone because price stopped, came up, based, and then ran up on this huge fair value gap candle, broke this little high, broke this supply zone here. So you could call this a valid demand zone. Taps it, gets a nice reaction. There's some other ones you could probably draw out in here, depending on how strict you are with your rules. This is another one. Boom, down. Another thing to note is that some of the gurus and the YouTube teachers out here will teach you that the supply and demand zones or order block zones are definitive, meaning that if price moves past them by one tick, one pip, one whatever, that zone is now invalidated. I have a system that allows me to trade past those zones. So like, I didn't take this, but this is a potential area that I could zoom down a smaller time frame, and even though it went past the zone, I could have been comfortable taking this trade based on my lower time frame entry models. And I do it all the time. There's many times when price goes slightly past the supply and demand zone and then gives me the signals that I need, and all of a sudden I'm in a trading back across the way, just like if it stopped in the supply zone, or it's just like it stopped in the demand zone. So it's very possible there's a lower time frame entry here. Now that doesn't work if you're doing pending orders, which is again one of the reasons I told you guys the pending orders on the zones did not work for me. I tried it, didn't work. But it might work for you. Okay, so listen to what I've got to say throughout my YouTube career here. Compare my notes to other YouTubers, to other mentors, to other gurus, and see what works for you. It didn't work for me. That's all I can say. And it's not a knock. All right. Then as we came into this past weekend, we had all the USD stuff with President Trump announcing Friday lots of tariffs on Canada and Mexico, and that really tanked the market, and then it opened up kind of still downward, but it looks like we're recovering now, and we're starting to trend back upwards. So that's why you had this big gap between Friday and Sunday was, the panic selling of the institutions and banks and whatnot because of the tariff situation. So there's a really, really brief, really simple theory on what supply and demand is. It is the area that price started a move from that broke opposing structure. Preferably strong moves with fair value gap candles. And I can do a lesson on that if you guys don't know what fair value gaps are. Preferably a move that's 2 to 3 times the size of the zone at least. And to indicate that there's good amount of orders there. And then a lower time frame entry model is how I handle those. So your homework is to go find you a chart, any chart you want, mark up a bunch of supply and demand zones, screenshot it, post it in the comments, and I will let you know what I think about it. I'll take your picture, I'll draw up on it, and I'll tell you what I think about it. Hope that helps, guys. This is the first very basic lesson. We'll have more to come. Y'all have a wonderful day and go make some money.